They told us Ford was booming, but take one look at the dealership lots, and the truth hits like a sledgehammer. Rows of F-One Fifties, Broncos and Rangers just sitting there. No buyers, no movement, just dust, weeds, and silence. This isn't a slow quarter, this is a full-scale breakdown. In small towns and major cities alike, dealers are running out of space. Ford's inventory crisis isn't just bad, it's historic. Trucks are being stored on grassy fields, off-site storage lots, even old stadiums. The company that once defined American strength is now choking on its own supply chain. So what went wrong? Why are buyers walking away in droves? And how did Ford turn its most iconic vehicles into liabilities overnight? What's happening? It hit like a slap to the face. In the midst of the worst inventory glut Ford had seen in decades, the company announced a sweeping price increase on its 2025 lineup. No apologies, no disclaimers, just a cold, calculated change to the sticker price. The F-150 was going up. The Bronco? More expensive. Even the Ranger, which dealers were already struggling to sell, got a bump. For customers still on the fence, it felt like betrayal. One loyal Ford buyer, who had been eyeing a Bronco Outer Banks model, said it best. "I waited through the pandemic. I waited through the chip shortage. I waited for the price to come back down. And now they're telling me I should have paid more." He walked away. So did hundreds like him. Dealers were furious, not just because higher prices made vehicles harder to move, but because they'd been burned before. During the pandemic, Ford had encouraged dealers to leverage high demand with steep markups, and it worked for a time. Customers paid premiums. The Bronco was hot, the Maverick was rare, the F-150 was untouchable. But by mid-2024, that narrative had collapsed. And now, instead of adjusting to reality, Ford doubled down on its delusions. Raising prices in a collapsing market wasn't just bad optics, it was suicide. Salespeople were left scrambling to explain why a 2025 model was suddenly thousands more expensive than a 2024 sitting 10 feet away. Some dealerships started offering under-the-table discounts just to get cars moving. Others turned openly hostile toward Ford, accusing the company of sabotaging their margins and morale. Inside showrooms, you could feel the tension. Floor managers quietly revised commission structures. Customer traffic dropped. Even test drive volume tanked. At one dealership in Illinois, test drives were down 40% year over year. When asked why, the sales director didn't mince words. The cars are overpriced, and the customers know it. The rift between Ford and its retail network grew deeper by the day. Franchise owners wrote open letters. Dealer councils pushed back. Even longtime Ford loyalists began whispering about switching brands. Toyota and Chevrolet were courting disgruntled Ford buyers with aggressive offers and trade-in bonuses. And it was working. But no vehicle revealed this disconnect more clearly than the one that was supposed to represent Ford's triumphant return to glory. And the car that proved it, the one that used to be Ford's golden child, the fall of the Bronco, from icon to liability. The Ford Bronco's comeback was supposed to be a victory lap. When it returned in 2021, it was hailed as a bold rebirth of an American classic. Waitlists stretched for months. Dealers tacked on markups so high they made headlines. Buyers paid them anyway. It was more than a car. It was a statement. But just 3 years later, the Bronco has become an albatross. Dealers can't give them away. They line the edges of dealership lots like forgotten toys, stacked in rows so thick they spill onto grass and gravel. At one point, the Bronco was one of the most sought-after vehicles in America. Now it's a liability. One buyer in Colorado recalled paying over $65,000 for a Badlands edition with all the extras. Today, that same model is being advertised online for under $50,000. Brand new. "I feel like I got played," he said. "They told me it was limited, exclusive. Now it's just everywhere." Jeep, Ford's longtime rival, seized the moment. The Wrangler Rubicon, often criticized for lacking the Bronco's modern tech, was now priced lower and more stable. Dealers were offering better financing terms, more incentives, and stronger trade-in values. The Bronco, once a symbol of rugged Americana, was starting to feel like a risky impulse buy. The collapse of Bronco demand exposed a bigger problem. Ford had banked on scarcity. They planned production and marketing around hype, not sustainability. But hype is fragile. Once the novelty wears off, what's left? In the Bronco's case, an SUV with a high price tag, a crowded segment, and fading desirability. Buyers who once boasted about their Broncos were now trying to unload them. Facebook Marketplace and used car lots were filling up with nearly new Broncos at steep discounts. Dealers tried to counter with factory rebates and creative leasing options, but the damage was done. The magic was gone. Ford overcommitted. They built too many, priced them too high, and forgot that the customer can only be dazzled for so long. The Bronco had become a case study in how to kill your own golden goose. But if Bronco fell, what does that mean for Ford's cash cow? F-150 pileup, the truck that stopped moving. For over 4 decades, it's been America's best-selling vehicle. But now, even the F-150 is gathering dust. Dealers across the United States are reporting record-high inventories of F-150s. High-end trims like the Lariat and King Ranch are being discounted by as much as $10,000, sometimes more. XLTs are being offered under $50,000 for the first time in years, and yet buyers aren't biting. The problem isn't just economic, it's psychological. Loyal buyers are asking the same question. If this truck is so good, why is it marked down so much? Heavy discounts signal desperation. Desperation signals decline. And decline doesn't sell trucks. The emotional collapse is real. For many, the F-150 represented the last strong pillar of American auto reliability. Seeing it struggle, even slightly, feels like watching a mountain tremble. It's more than a sales slump. It's an identity crisis. Dealers are rejecting new shipments. Inventory managers are cutting reorders. Online listings for brand new trucks are flooded. And with more electric and hybrid options entering the market every month, the traditional F-150 is losing its edge. Worse yet, the situation with the electric F-150, the Lightning, is even more dire. The electric version? That's where things really went dark. If you're still with me, you're the kind of person who looks past the headlines. If you want to stay ahead while the walls come down, hit that subscribe button now. Lightning Shutdown, the EV that blew out early. It was supposed to be a revolution. Ford's F-150. Lightning wasn't just another electric vehicle, it was the company's all-in bet on a new era. It fused America's best-selling truck with cutting-edge technology. On paper, it was perfect. Real-world torque, 4-wheel drive, a frunk, onboard power, and more battery capacity than most competitors could dream of. When Ford unveiled it, the hype was immediate. Wait lists filled up overnight. Videos of its insane acceleration and power your house features went viral. Even skeptics started to believe that maybe, just maybe, Ford was about to own the electric future. But that future came with a catch. Actually, it came with a price tag. The base Lightning originally launched at under $40,000, but it didn't stay there for long. As inflation rose and supply chain headaches mounted, Ford raised prices repeatedly. By the time the 2024 models hit showrooms, the extended-range Lariat was pushing past $85,000. That wasn't just a price increase, it was a repositioning. What was originally pitched as the EV for everyone had become an expensive luxury truck that only a small segment of buyers could even consider. And that's when things started to fall apart. Demand slowed, enthusiasm faded, and then came the silence on the factory floor. At Ford's Rouge Electric Vehicle Center in Dearborn, Michigan, the production lines went quiet. What was supposed to be a state-of-the-art facility, humming with progress, suddenly became a ghost town. Trucks that had once backlogged orders were now sitting untouched. Dealers started refusing new shipments. Inventory ballooned, and the message from buyers was deafening. The Lightning was too expensive, too soon, and too out of step with what real truck buyers wanted. Internally, engineers knew the specs were solid. It wasn't about performance, it was about practicality. Electric trucks still lacked the infrastructure support for rural work users. Long-haul, towing-heavy drivers couldn't rely on sparse charging stations. Add to that a fragile economy and rising interest rates, and the Lightning became less of a must-have and more of a symbol of misplaced ambition. Ford bet on emotion. Buyers responded with caution, and the result? A complete production freeze. No new Lightnings until demand catches up, which might be never. And when the numbers came in, they were worse than anyone expected. $37,000 lost per car. When Ford's quarterly financial report dropped, the numbers hit like a wrecking ball. Model E, the company's dedicated electric vehicle division, had lost $1.2 billion in the third quarter of 2024 alone. But that was just the beginning. Over the course of the first 9 months of the year, total losses from the division reached a staggering $3.7 billion. That's not a typo. That's not a rounding error. That's $3,700,000,000 gone. Ford had sold roughly 32,000 electric vehicles during that time. Do the math, and it comes out to around $37,500 lost for every single electric car or truck delivered. That is more than the price of many of the vehicles themselves. For every Lightning on the road, Ford lost a year's salary. For every Mustang Mach-E, Ford took a hit it couldn't afford. The reason wasn't a mystery. Battery prices were still too high, supply chains were fractured, economies of scale hadn't materialized. And worst of all, Ford didn't have the kind of vertical integration that Tesla did. Tesla builds its own batteries, writes its own software, and controls nearly every component of its cars. Ford, like most legacy automakers, relies on sprawling, vulnerable global suppliers. That means higher costs, longer timelines, and fewer efficiencies. This isn't just a failure of execution, it's a crisis of strategy. Ford went big on electric, it priced high, it scaled fast, and it misjudged the customer. Now it's paying for it in billions. And that's when the global price war crushed whatever was left. The EV price war Ford can't win. It started with a single decision, Tesla slashing prices on the Model Y. Then came the Model 3, then the rear-wheel drive version. One after another, Elon Musk's company cut deeper into margins, daring others to follow. Ford tried to hold its ground. BYD didn't blink. They undercut Tesla, offering electric vehicles with solid performance for under $15,000 in China. Toyota, never rushed but always calculated, launched a $13,000 electric SUV with help from its Chinese partners. Suddenly, the idea of a $75,000 Lightning or a $55,000 Mach-E didn't seem premium. It seemed disconnected from reality. Ford was stuck. Its EVs were too expensive to drop prices without incinerating what little margin remained. Unlike Tesla and BYD, Ford didn't have the manufacturing cost advantages to play the price war game. Each time competitors lowered prices, Ford either had to absorb the blow or risk looking overpriced. Either way, they lost. Global EV supply was ballooning. The market, however, wasn't growing fast enough to keep up. Consumer interest was softening. Infrastructure still lagged behind. High interest rates made financing harder. Even federal EV tax credits couldn't offset the sticker shock of Ford's lineup. The price war wasn't just shrinking Ford's market share, it was vaporizing its profitability. And as Ford watched rivals win on cost, volume, and perception, one uncomfortable truth emerged. Ford wasn't just losing sales, it was losing the future. Its strategy wasn't keeping up with reality. It had too much weight, too much legacy cost, too many internal divisions. But Ford's biggest battle wasn't against the market. It was within itself. Ford's overproduction machine runs wild. Ford's collapse wasn't triggered by one catastrophic decision. It was the result of 1,000 wrong assumptions compounded over time. Nowhere is that more obvious than in its manufacturing and inventory management. The post-pandemic auto industry came with new rules, but Ford was still playing the old game. They assumed that high demand during the chip shortage years would continue indefinitely, and that assumption became a noose around their neck. With factories running full tilt and supply chains cranked to maximum throughput, Ford pumped out trucks and SUVs at a rate that didn't match real-world demand. Inside Ford's logistics and operations division, the alarms had been sounding for months. Internal forecasting memos showed a steep dip in consumer interest, starting in late 2023. But leadership didn't listen. Production schedules stayed aggressive. Marketing teams pushed inventory readiness as a selling point. Executives believed demand would come back. It didn't. As a result, dealer lots began to overflow, not just with new models, but with last year's inventory that never moved. Ford signed overflow contracts to store unsold vehicles off-site. Entire fields outside urban areas were converted into makeshift holding zones. Some dealerships began quietly turning away new shipments. They didn't have room. Worse, they didn't have buyers. Regional managers sent blunt warnings up the chain. "Stop sending us trucks we can't sell." One dealer in Texas described his lot as a used car graveyard, but all the cars are brand new. And when leadership tried to pivot, the company fractured. Civil war in the boardroom. Ford's boardroom had become a battleground. What should have been a unified war room guiding the company through a crisis turned into a civil war of ideologies. On one side stood the new school executives, those pushing to double down on electric vehicles, innovation, and connected services. On the other stood the traditionalists, those who saw salvation in the F-Series, the Mustang, and the combustion-powered past. It was not just a disagreement, it was open conflict. Executives debated whether to pour more investment into the Mustang Mach-E or preserve capital to protect the future of the gasoline Mustang GT. The chief financial officer clashed repeatedly with marketing leadership over branding priorities. Engineers were caught in the crossfire, unsure whether to focus on battery advancements or truck towing capacity. Ford's executive meetings, once laser-focused on execution, became mired in philosophical disputes that never ended in decisions. Jim Farley, Ford's CEO, tried to straddle both sides, promoting the Ford Plus plan while defending traditional platforms, but ended up pleasing neither. The result was paralysis. Initiatives were delayed, launches were pushed, budgets were frozen, not because of financial limitations, but because no one could agree on what mattered most. One executive assistant described the vibe inside Ford's upper ranks as half Apollo mission, half Game of Thrones. This kind of dysfunction doesn't stay secret for long. Rumors of high-level resignations leaked. A restructuring of product leadership triggered more questions than answers. Externally, Ford tried to project confidence. Internally, it was in chaos. The company didn't just need a strategy, it needed a decision. And while they fought over what direction to take, Ford's biggest partners were making moves of their own. And while they fought, Ford's biggest partners started walking away. Dealership exodus. AutoNation dumps Ford. The most alarming blow didn't come from Wall Street or the media. It came from within Ford's own retail ecosystem. AutoNation, the largest automotive retailer in the United States, made a decision that rocked the industry. It sold 8 dealerships in a single quarter. 5 of those were Ford. AutoNation is not known for impulsive moves. Their empire was built on smart investments, cold data, and sharp timing. So when they chose to divest from Ford, it wasn't about trimming fat, it was about cutting losses. The Ford dealerships they dropped had become liabilities. They weren't just underperforming, they were becoming toxic assets, dragging down regional performance, and absorbing too much capital in inventory and floor planning costs. What made the move more significant was the timing. AutoNation had just completed a strategic review of its brand portfolio. While Toyota, Honda, and luxury imports continued to perform, Ford locations were bleeding margin. Vehicle turnover slowed, incentives became necessary, customer feedback dipped as frustration grew around delivery delays, pricing confusion, and EV product inconsistency. From a business standpoint, AutoNation had no choice, but from Ford's standpoint, it was a gut punch. Other dealer groups started whispering. Smaller franchise owners began reevaluating their Ford relationships. A ripple of concern began to swell. Would Ford support the dealers stuck with aging Broncos and overpriced F-One Fifties? Would they adjust pricing or abandon retailers to deal with the mess alone? Investors noticed, and the stock reacted fast. The 4% drop that shook confidence. When Ford released its third-quarter earnings report, it was clear that the numbers didn't just miss. They deflated the narrative. On paper, there was good news. Revenue came in at $46.2 billion, a 5% increase year over year. But Wall Street doesn't trade on revenue, it trades on profit, and that's where the floor gave out. Net income dropped to $900 million. That's a sharp fall from the $1.2 billion Ford earned in the same quarter a year earlier. Earnings per share fell to 22 cents, missing analyst expectations by a wide margin. And worse, Ford slashed the top end of its full-year forecast, cutting it from $12 billion down to 10. For investors already anxious about rising interest rates and softening consumer demand, this wasn't just disappointing, it was confirmation. Confirmation that Ford was over-leveraged, that their electric bet was bleeding too much, that dealerships were floundering, that investor patience had limits. In after-hours trading, Ford stock dropped more than 4%. It was the kind of drop that signals something deeper than a bad quarter. It was the kind of drop that hints at systemic cracks investors can no longer ignore. And those cracks weren't new, they were just harder to cover up. Morgan Stanley had already downgraded Ford's outlook weeks earlier, citing concerns about profitability, long-term direction, and unresolved labor negotiations. The earnings miss validated every doubt. Analysts pulled no punches in their calls. Ford had lost its edge. It's not that Ford can't come back. It's that Wall Street no longer assumes it will. A stock drop can be reversed. Confidence? That's harder to earn back. While Ford floundered to define itself, its fiercest rivals were executing with brutal precision. Toyota, Tesla, and BYD move in for the kill. While Ford was busy debating its identity, its competitors were busy taking its market. The global EV race isn't just about innovation. It's about speed, scale, and pricing power. And Ford lost ground on all three fronts. Toyota, Tesla, and BYD didn't just outpace Ford, they humiliated it. Toyota's strategy hit the industry like a thunderclap. Their newly launched all-electric SUV stunned everyone with a base price of just $13,000. And no, that wasn't a stripped-down city commuter. It was a full-size sport utility vehicle with a 14-inch touchscreen, adaptive cruise control, and enough room to compete directly with Ford's Bronco Sport and Escape. Where Ford offered discount rebates to move aging models, Toyota brought a brand new vehicle to market that made Ford's offerings look both overpriced and outdated. Tesla, meanwhile, solidified its dominance not just through product, but infrastructure. Its supercharger network remains the most robust, and it's now open to other brands, creating another revenue stream and locking in charging convenience. Tesla's software updates, autonomy package, and vertical integration strategy continue to reduce costs and improve margins. Ford simply can't keep up. Its EVs are losing tens of thousands of dollars per unit, while Tesla is making money on every sale and growing faster. Then there's BYD, the Chinese powerhouse that's rapidly expanding across Asia, Europe, and now Mexico. They're pumping out more than 30,000 electric vehicles a day, many of which come in below $25,000, loaded with tech and boasting impressive battery longevity. Ford, by comparison, is reducing EV production, laying off workers, and leaning on old inventory to patch balance sheets. And this isn't just a foreign takeover, it's a reshaping of Ford's traditional strongholds. BYD is targeting fleet deals. Tesla is absorbing tech-savvy early adopters. Toyota is reclaiming middle America buyers with bulletproof reliability and affordability. Ford, it's stuck in limbo, unable to match price, technology, or message. Now, with competitors swarming in and Ford bleeding relevance, one brutal question is echoing from town halls to boardrooms. Is this the end of Ford? Can Ford survive the next decade? This is no longer about market share or quarterly earnings. This is about survival. What was once the mightiest automaker in the world now faces the same question haunting so many legacy giants. Can it adapt fast enough to remain relevant? Or will it become a cautionary tale in the textbooks of the next generation? A century ago, Ford didn't just build cars. It invented modern industry. It created the assembly line. It created middle-class jobs. It created a cultural identity. But now, in 2025, Ford is caught between the very forces it once shaped: automation, globalization, and the brutal logic of capitalism. The company's product lineup is fractured. Its leadership is divided. Its investors are spooked. Its dealers are retreating. And its workers, they're watching the ground shift under their feet. Ford is too big to pivot like a startup, too slow to innovate like Tesla, and too bloated to undercut prices like BYD. So what's left? Survival will depend on radical decisions, cutting EV losses, focusing on one or two core models, rebuilding trust with dealers, restructuring factories for modular production, maybe even merging with another automaker. But none of these options guarantee success. They only delay collapse if executed without conviction. What's happening to Ford isn't unique. It's a warning for every legacy brand in America. When you fail to choose an identity, the market chooses one for you. And that identity, increasingly, is irrelevant. What do you think? Is Ford about to pull off one last miracle? Or is this the final meltdown? Drop your thoughts in the comments. Hit subscribe if you want real breakdowns without the sugar coating. And I'll see you in the next one.